After the market trades inside a range, it breaks below the support level. You spot a bearish engulfing candle, enter a short position, and within moments the market reverses sharply, trapping your trade. This happens to traders every day because they rely only on candlestick patterns without understanding what the candles are actually telling them. In today's video, you'll learn how to read candlestick patterns correctly and identify high-probability trade entries instead of falling into common traps. Every candlestick on a chart contains 4 important pieces of information: the opening price, the highest price, the lowest price, and the closing price. These 4 values determine the candle's shape and size. The bigger the difference between the opening and closing price, the larger the candle body becomes. When a candle closes above its opening price, buyers are in control during that time period. When it closes below its opening price, sellers are in control. For example, if a 5-minute candle closes bullish, it shows that buyers dominated those 5 minutes. If the next candle also closes bullish, buyers continue to maintain control. But if the following candle opens higher and closes lower, sellers have gained control during that particular 5-minute period. Now, many traders immediately assume that it's time to enter a short trade, but that conclusion is often incorrect. Instead of looking at a single 5-minute candle, combine those 3 candles into one 15-minute candle. You'll notice that the 15-minute candle closes almost exactly where it opened. This tells you that neither buyers nor sellers are actually in control. The market is balanced, and there is no clear directional strength. Entering a trade based only on the last bearish candle is a low-probability decision. Let's look at a real example. On the 5-minute Bank Nifty chart, after a period of consolidation, price breaks below the range and forms a bearish engulfing pattern. Most traders see this as confirmation that sellers have taken control and immediately enter a short position. In reality, this is one of the biggest mistakes traders make. Before the breakdown, price had already formed a fresh swing low and then bounced from that area. This indicates that buyers are still active and defending that price level. If sellers truly want to take control, the market must close decisively below that swing low. Simply forming a bearish engulfing candle is not enough. Although the red candle appears strong, it fails to close below the important swing low level. This tells us that sellers have not fully established control over the market. Without confirmation, entering a short trade here only increases the chances of getting trapped in a false breakdown. The key lesson is simple. Never trade a candlestick pattern in isolation. Always analyze the higher time frame, market structure, swing highs and lows, and whether buyers or sellers have actually gained control before entering a trade. Therefore, instead of entering a trade immediately, you should wait for the candle to close below that key level. But in this case, the next candle moves higher instead of continuing downward and closes above the area where the initial rejection occurred. This clearly shows that sellers have failed to maintain control. Rather than continuing the downtrend, the market first sweeps the liquidity resting below the lows and then moves upward to capture the liquidity positioned at higher levels. Notice that the psychological level of 55,000 is acting as strong support in this area. As long as this level remains intact, aggressive selling is unlikely to enter the market. This is why trading solely based on candlestick patterns is a mistake. Without considering market structure, liquidity, and key support or resistance levels, your trades are far more likely to end in losses than profits. Today, most traders understand the basics of technical analysis, but they still struggle with one important question: where should I enter, and where should I exit? Now let's understand one of the most misunderstood candles on the chart. In both bullish and bearish trends, you'll often notice a very large momentum candle. This is commonly called a bullish momentum candle or bearish momentum candle because it reflects one-sided dominance by buyers or sellers. These candles usually appear during periods of high volatility when the market makes a powerful move. However, in reality, these candles often become traps for retail traders. For example, on the Nifty 50 5-minute chart, a large bullish momentum candle forms around 9:50 a.m. after a period of consolidation. Most retail traders assume that the range has broken out and immediately enter a long trade. But instead of continuing higher, the market reverses, hits their stop loss, and they lose their first trade of the day. A little later, after the price declines, another large bullish candle appears. Thinking that the market is finally reversing, they enter another long position. Once again, the price falls, triggering another stop loss. Now, after getting trapped twice, the trader decides to wait patiently for a confirmed breakout. Eventually, the market forms yet another strong bullish momentum candle that appears to break the range convincingly. Confident that this breakout is real, the trader enters a long position once again. Within minutes, the market reverses sharply, trapping the trade for the third time in a single session. This is exactly how large institutional traders exploit retail psychology. They create panic, excitement, and FOMO by printing unusually large candles. As emotional traders rush into the market, they provide the liquidity that institutions need to execute their large orders. That's why whenever you notice a candle that is significantly larger than the surrounding candles, avoid chasing it whenever possible. Most of these candles are designed to attract retail traders at exactly the wrong time. If you study historical charts, you'll find that these oversized momentum candles produce successful continuation trades only occasionally, while many of them end up trapping traders. Now let's move on to the next important type of candle, the rejection candle. This candle is commonly known as a hammer or an inverted hammer. Its most noticeable feature is a long wick with a relatively small body. That long wick represents price rejection. For example, on the Nifty 50 5-minute chart dated the 9th, price rejects from an important level near the 25,000 psychological zone and forms candles with long lower wicks. Here's what this candle tells us. The price opens at one level, moves sharply lower, but then buyers step in with enough strength to push the price back near its opening level before the candle closes. This means sellers were initially successful in driving prices lower, but they failed to maintain control. Buyers absorbed the selling pressure and showed their willingness to defend that area. On this chart, buyers have attempted nearly 3 times to protect the lower price zone. Each rejection from the same level confirms that buying interest is increasing. However, a rejection candle alone is not a buy signal. It should always be confirmed with market structure, liquidity, and follow-through price action before entering a trade. As the downtrend continues, you'll often notice that the candles gradually become smaller. This is an important clue that selling pressure is weakening, and sellers are slowly losing control of the market. If the price later closes above the last significant bearish candle, it provides the first confirmation that a potential bullish reversal may be developing. Once that confirmation candle closes, a long trade can be planned. Since buyers have successfully overcome the sellers, the market often responds with a strong upward move. The opposite principle applies during a bearish reversal. After rejecting from higher levels, the price begins to move lower. When long wick candles appear near an important support or resistance zone, they reveal that the market is rejecting those price levels. Long lower wicks near support suggest buying interest, while long upper wicks near resistance indicate increasing selling pressure. However, a rejection candle alone is never enough. Always wait for the price to break out of the rejection range before entering a trade. Once you're in the position, stay with the trend until a candle closes beyond the rejection zone in the opposite direction. That rejection area acts as a protective level for your stop loss, so your risk should always be managed around it. Now let's understand the third type of candlestick, the indecision candle. An indecision candle forms when buyers and sellers are equally uncertain about the market's next direction. In this type of candle, the opening and closing prices are almost the same, creating a small body with long wicks on both sides. This tells us that neither side has established control. These candles commonly appear when a strong trend is losing momentum. As volatility decreases, price begins moving sideways instead of trending. During this consolidation phase, several indecision candles usually form one after another, showing that the market is waiting for fresh buying or selling pressure. Sometimes you'll also see a long upper wick candle followed by a long lower wick candle, or vice versa. If you mark the highs, lows, and closing prices of these candles, you'll notice that they define a temporary trading range. This tells an important story. At first, buyers pushed the price higher, but sellers rejected those higher prices and forced the market back down. Then buyers defended the lower prices and pushed the market back toward the opening level. This constant battle shows that both buyers and sellers are uncertain about the next move. As long as the price remains inside this range, avoid taking trades in either direction. Wait patiently until the market closes decisively above or below the range before considering an entry. Whenever you analyze a chart, don't just identify candlestick patterns, study the size of the candles as well. Candle size reveals the strength of market momentum. For example, imagine the market falling sharply with several large bearish candles. This tells us that sellers are highly aggressive. But as the decline continues, the candles gradually become smaller and develop long wicks on both sides. This is a clear sign that selling momentum is fading and fewer traders are willing to initiate fresh short positions. As momentum weakens, the probability of the downtrend continuing immediately becomes much lower. Unless the market spends time consolidating and attracts fresh sellers, another strong bearish move is less likely. In these situations, fake breakouts become much more common because large institutions use them to trap impatient retail traders before the real move begins. The most important lesson is this: don't memorize candlestick patterns. Understand the psychology behind them. Every candle reflects the ongoing battle between buyers and sellers. When you combine candlestick analysis with market structure, liquidity, momentum, and confirmation, you'll dramatically reduce the chances of getting trapped in false moves and make far better trading decisions.